Okay, so we now move on to the topic of risk management, which for me and all professional traders is the holy grail of trading success. It's really, really important that we think about capital preservation first and then capital growth second. Sadly, as a trader, we will have losing trades. So when they come along, we want to make sure that they're kept very, very small so they don't damage our capital and unravel a number of good profitable trades. So let's take a little bit more of a look at risk management in terms of what we need to do in our approach to make sure we preserve capital at all times. But firstly, an overview. So as I mentioned, risk management, which is also known as money management, it's the management of your money, is the holy grail of trading success. Without it, you are simply gambling, because if you never know what your worst case scenario is, then you're gambling. You're tossing a coin and you're hoping for the best. So we always want to know before we even take a trade what our worst case scenario is. And then we're prepared to accept that and say that if that happens, it's only a small loss and we can recover from that rather than it being damaging. A trader without any capital can't make any money. So preservation of your capital should always be your first thought and capital growth second. Now, when a boxer gets into the ring, the referee always says to them, protect yourself at all times. That's exactly what should be front of mind as you as a trader. Protection of capital first, growth second. Okay, so going into more specifics now, we recommend to keep your risk low on every single trade so that you grow your account gradually month by month. Your losses are kept small so that your profits can override them and generate your consistent profits on a month by month basis. Now, we use a small percentage of account risk on every single trade, and we advise you to do the same. Now, if you do wish to risk more, which you can do, please do so with the understanding that not only will your gains be bigger, your losses will be too. And you can't underestimate the psychological impact. When you start to risk big, it starts to play tricks on your mind as well from a psychological perspective. If you can take a trade knowing that actually your worst case scenario is X and you're more than happy to accept that, psychologically, that is a wonderful position to be in because it takes away an element of the fear. Always start small, naturally, because when you first start to trade the news, it's going to be fresh, it's going to be new. So, of course, it's going to take a bit of time for you to master these skills. So start small with 1% risk per trade of your capital that you've funded your account with, and then as you grow your experience, you grow your results, and more importantly, you grow your confidence, then yes, we can absolutely look to risk a little bit more per trade, but never creep any higher than 3% risk per trade. That would be the top of the level. Again, main reason for that is a psychological one. Once you start to risk big, it starts to play tricks on your mind, which can cause you to then become very sporadic with your trading approach. We want to be as logical as possible, and the best way to be logical is when we're cool, calm and collected, which means that we're going into trades risking an amount which we are happy with. Okay, so how do we work out? Because the broker's going to want to know where you want to get into the trade. That's your live execution, where you want to put your stop loss and where you want to put your target. But also they're going to want to know how much do you want to trade. So this is known as your trade size or your trade volume. So the golden calculation is very, very simple, but massively important. So let's go through that. So you take 1% of your account, and obviously with experience that can move to 3%. You take 1% of your account, and this is your account balance, so how much you funded your trading account with. And you divide that monetary amount by the pips at risk on the trade, which we know is very easy to work out because the risk in pips on every single trade is going to be 80. So it's 1% of your account in monetary terms divided by 80. And this will give you an amount per pip that you can place on the trade. Now, I mentioned there your lot size or your volume. We're going to go through this and explain it in a bit more detail, but just think of the amount per pip for now. Let me show you an example. So you're a trader that has £10,000 in your trading account. 1% of that is $100, as it says here, and you can relate this to any account denomination that you have. So if it's a pound account, a euro account, etc., you do the same process. So a $10,000 account in this example, 1% of that account is $100. That's the maximum I'm prepared to risk and lose if the trade doesn't go in my favor and stops me out. If it stops me out, it'd have to go 80 pips because that is where my stop loss goes on every single trade. Bearing in mind that what we talked about is not every losing trade is going to hit your initial stop loss because of the management techniques we're going to use, i.e. moving our stop to break even, or after an hour, cutting the trade for a smaller loss. But we need to go into the trade thinking that a trade could hit our worst case stop loss, which is 80 pips. So we always risk manage on the full 80 pips. So $100 divided by 80 then says that we can put on this trade $1.25 per pip. So every pip we make $1.25. Every pip that we lose is minus 125 up until our 80 pip stop loss is hit and we lose the $100 on that particular trade. However, I've also mentioned here it's 0.12 lots per pip or 12,500 units equivalent. So this is what we're going to go through on the next slide to explain that, because in trading it's not as black and white as just the dollar amount per pip. They actually deal, professional trading institutions such as FX Pro deal in lots or units of volume, but we're going to explain that on the next slide. But it's a very simple calculation. However, you can't underestimate its importance. In terms of helping you with this, I'm going to show you an online calculator that's going to do the majority of the work for you and make your life a lot easier, but we'll come on to that in a second. Just to confirm that, so working out your trade size or volume, remember we use a fixed stop loss of 80 pips, meaning that we can use a fixed lot trade size or a fixed position size. So it's going to be the same position size every single trade. So remember that helps with your speed of execution, because you will know every single trade your position size is going to be the same, or you can at least work it out before you take the trade, so you're not spending 5 minutes working it out when the market's moving without you. We want to just get our position size sorted, and then as soon as we pull the trigger, we're into the trade. We're not having to worry about our risk management because that's already been done. And the reason why we do that, we have the same position size every single time. Remember I mentioned earlier that we expect to be pip positive at the end of the month, i.e. we've made more pips than we've given back, meaning that we're pip positive. So if we've made a positive amount of pips and it's the same amount per pip, i.e. $1 per pip, we will inevitably be making money at the same time. So when we make pips, we make money as a byproduct of that. Okay, so let me explain to you lots and volume, because depending on which platform you choose, whether you choose the MT4 or you choose the C-Trader, this will determine whether you use lots or units or volume of currency. So let me explain. So in the professional trading industry, trading volume is done in lots. Let me explain the various lots. So you've got your standard lot, your micro lot, and your nano lot. So your standard lot, in terms of its denomination, would be 1.0. It's the equivalent of buying or selling 100,000 units of the base currency per trade, which in layman's terms is the equivalent of $10 per pip. So that's what it means in layman's terms. A micro lot is a tenth of the size, so it's 0.1, which is the equivalent of buying or selling 10,000 units of the base currency, which in layman's terms is roughly $1 per pip. And then finally, if you've got a small account, then you will use nano lots, which is a lot denomination of 0.01, a hundredth of the size of a standard lot, which is the equivalent of buying or selling 1,000 units of the base currency, which is roughly 0.10 per pip. The beautiful thing about this means that you don't need a huge amount in your trading account to get started, because you can take trades which are nano lots or position sizes in nano lots, which is the equivalent of 10 cents per pip, or if you're in the UK, the equivalent would be 6p per pip. So you can trade with very, very small quantities as a new trader as you get used to trading the news. And then obviously you can build up your size as you grow with confidence, experience, and results. So as you see here, just to confirm that, one standard lot, you would be buying or selling 100,000 units of the base currency per trade. A 0.1 standard lot, which is a micro lot, would be buying or selling 10,000 units base currency, and then finally your nanolots, which is your smallest position size, you'd be buying or selling 1,000 units of the base currency per trade, which the equivalence per pip in monetary terms is $10 per pip for a standard lot, $1 for micro lots, and 0.10 for nanolots. And you can use multiples of these, so you can use 2 standard lots, which would be $20 per pip, 3 standard lots, which would be $30 per pip, etc., etc. Now, I find this personally quite hard to understand and digest. So I'm going to give you a tool which does the legwork for you, and you're literally copying and pasting into your trade ticket when you're about to place the trade. So here it is, a quick cheat. You need to go to the following website, www.owenforex.com/position-size-calculator. Fill in all your details, as you can see here. So it's very easy to do. Firstly, you've got your account currency. You will put that in the currency that you've funded your account with. I've used dollars to keep in line with the example we went through earlier. The account size is how much you have in that account, so $10,000 in this particular example. The risk ratio is how much you want to risk of that account size. So we've put 1% of our account. And then the stop loss is always going to be 80 pips. Then you can select the currency pair that you are wanting to trade. In this example, euro dollar. When you then click on calculate, it will pre-populate these boxes underneath. So go through, put all your details in, click on calculate, and that will pre-populate the results. And this will give you a trade size. Let's go through the results and what they mean. So the box 1 is money in your currency that you have funded your account with. So in this example here, it's a dollar-based account. So it's saying that if this trade gets stopped out, it would be a loss of $100. So that's your sanity check. You always want to make sure that that amount there is the amount that you're prepared to risk. So in our example, we were prepared to risk $100. That confirms it. That backs up that everything's been calculated correctly. And then more importantly are these two elements down here. Is the units, which is the volume, and the lots, which is, by its very nature, the lots. So as point 2 says, units is the volume you are buying or selling. You will use that on your CTrader platform if you've downloaded the CTrader platform. And all you do is you literally copy that number there, 12,500, and paste it into your trade ticket. And I'll show you how to do that in accompanying videos. If you're using MT4, however, you will use lots. And again, we can do the same process of simply copying that 0.12, copying that and pasting it into our trade ticket. Again, I will show you how to do that in the accompanying videos, as well as bringing up the position size calculator and talking you through that process. But it's a wonderful tool. Again, another free tool that you can take advantage of to make sure that your position size and your risk management is spot on every single time. And you will do this before you place the trade, and then you will input into your trade ticket. So then all you're waiting to do is listen into the news, make sure that your trade plan comes together, and then you are clicking the button. You're going into the trade that you want to go into for the position size you want to trade at. And as it says there, it's doing the hard work for you, this calculator. It sanity checks your own calculation. Remember that top box there is your sanity check. Do I want to risk $100? Yes, that's what I'm prepared to risk. Great. If it's a different number, then obviously you've done something incorrect and you just need to change your numbers. And as it says there, please view the video to see it in action, to bring you up to speed and have a play around with it, get used to it, get comfortable with it. But like all of the resources I've given you throughout this course, they're cost effective and they're very, very efficient in helping you become the most proficient trader possible trading the news. Okay, so just to bring it all together, to summarize, keep your risk small on every single trade. We suggest no more than 1 to 3% per trade. Remember, that will be based on your experience, your confidence, and your results. We always want to preserve capital first, think about growth second. Slow and steady wins the race. You will be amazed at how much profit you can generate over 6, 12, 18, 24 months. But if you don't risk manage and you blow up on one trade, it's all over. Take a slow and steady approach and you will make some fantastic returns over time. Use the online calculator to help work it out. I know it can become a little bit complicated when you think about lots and volume, but essentially that calculator makes your life easy. It does the legwork for you, and then you can simply copy and paste it into your trade ticket. Once you've obtained that information, it's very, very easy to pop it into your trade ticket. Remember, speed of execution is really, really important. I'll keep drumming on about that. So you want to have your trade size worked out in advance. You don't want to be doing it afterwards because you're going to miss out on time and profit. And to bring it all together and to bring it all to life for you, there are videos within the curriculum demonstrating live how to work out your trade size and how to input it into your trade ticket so you become absolutely comfortable with that. But do not underestimate the power of risk management. It is the holy grail to long-term success. Keep your losses small, make your winners as big as possible, and over time, your profit will outrun your losses.